Hello and welcome to another episode of Market Masters. Today we have with us Manish Chokhani, Director at Enam Holdings, one of India's most respected financial minds. It's been 5 months since we last spoke with Manish. Manish, welcome back.
Thanks for having me back.
The hot seat. Manish's big call when we last spoke, and it's been his call for longer than that, was that hard assets will do very well. Given the state of the world, given the general should I use the word despondent state of the world, I went back and checked what has the Nifty done, what has gold prices done since last time we spoke, since we had Manish here, which is from the 15th of April. So from that point on, MCX gold, so we want to compare, same currencies, MCX gold, which is in rupee terms, is up 17-18%. The Nifty in the same period from the 15th of April till now is up 6%. So you got, a 3x kind of outperformance on gold as compared to what the Nifty has done. Of course, this is a very short time period. You can stretch this longer, and I think the outcome does not change, maybe even gets even sharper in that sense. So he's got that particular call bang on. His other big call was that India is uniquely placed in the new Trump world. Now, the outcome for this has been a little mixed. We are uniquely placed, but on the other end of the spectrum. Manish?
Sure.
So I want to start with that.
You want to get me thrown out of the equity markets, yeah?
Just crazy, right?
Yeah.
Who would have thought?
Yeah, honestly, for what's happened with US and India was a surprise to everyone, I think, including to the protagonists over here.
Yeah.
Something changed during Sindoor.
Yeah.
And then I'm guessing something's changed over the last 1 week again to bring things back to what looks like even keel. But yeah, if you zoom back in a larger context, India and US have been the two best performing markets in the world, the best democracies and the best sort of places for capitalism to thrive.
Yeah.
So that narrative doesn't change. You get, as people say in geopolitics, from time to time you have spats with friends and you only have a spat with someone you love, I guess.
Yeah.
So I think that comes back on even keel. Having said that, this market was being driven or is being driven really by price agnostic domestic flows. And you saw it kind of shrugged off this tariff shock as if nothing had happened.
Yeah, the market has barely responded.
Yeah, but it's actually a small segment of the market which would have been affected because he exempted pharmaceutical, because generics, half of what the US consumes comes from India. So they would have been shooting themselves if they did that. And then they had to exempt electronics because all the iPhones which go would have landed up more expensive to them. So of the 80-odd billion, 40 billion was anyway excluded from this tariffs. And the big numbers which got affected were, unfortunately, textiles. Textiles constitutes a very small portion of the market.
Yes.
And there are 2, 3, 4 companies which are relevant over there, which also did not really fall as much. Because market also looked beyond ki 6-8 mahine mein ye kuch na kuch ho jayega. And which seems to be the case. Plus, there was also on the horizon the EU FTA, which also should then come and then give a fillip to all these exporters. But the larger issue, of course, remains that India, as an emerging third largest economy of the world, is still not a player in global trade. So we don't seem to have stuff which the world really misses, and therefore we didn't have cards, whether it is China or like Trump famously says, you don't have the cards, you don't have the cards. So there were no cards really.
What are rare earth?
Yeah, so like how China just switched that off and, boom, there was no noise about China buying oil from Russia and so on and so forth. So we clearly will need to step up our act to become a little more important in the world.
So let me ask you this.
I'll just close on that, but it's also created some difficulty with every country in the world now wanting to localize and bring back investments into their country. It puts a question mark on FDI. Because if you were looking for Americans to invest in India, Europeans to invest in India, it may be written into our FTAs, like we signed one with the Europeans, excluding the EU, the one he did with Switzerland and others. Yeah. But it's over 10 years. And if everyone is going to, for example, even in Europe, invest in their infrastructure, invest in their energy, and invest in their defense, US wants to bring semiconductors and everything back to the US. What is the 2-3% FDI flows that we were looking for? What happens to that? Number two, if this domestic flow keeps pushing asset prices up so much in India, the other smart money, which is private equity, tends to then not make investments in, and rather they've been taking investments out. And thirdly, you're finding the strategics to whom typically we sold our companies are now the Akzo Nobels are selling to our Jindals, for example. And the Bhartis and the Singtels are selling down to our retail investors. The Koreans are coming and selling down to our retail investors. So that's a bit of a muddle we are in. And in that context, if you don't have an export engine firing, you don't have an FDI engine, you don't really have a capex engine, I think it was inevitable that what happened with this GST to kickstart this consumption cycle is a necessary and a great thing that the government has done.
Manish, so just to tie off that US-India point, what is your forecast? You think it'll get done before the end of the year?
I mean,
look, I mean, the 25% of course has to go.
Yeah, I mean,
right?
you're not going to get to, I mean, again, it doesn't change anything.
Yeah.
Even if you get to the 15 which the allies have, which is Japan, Korea, UK, I don't think we get to 15. But if you're at 25 and you have some way around that, let's see, maybe we end up at 20.
Yeah.
But again, like I said,
Likely is 20 or 25? Just for
my bet would still
I won't hold you to it, but
well, I would still hope for 20, but clearly can't be more than 25. I would hope for 20. But having said that, what is this 20? If it's still only textiles, gems and jewelry, because the whole premise was that we'll be able to become friend-shoring, to bring US manufacturing to India. And if you take the India narrative of the last 10 years, what have we done? Compared to the 1990s, when we took white-collared people and put them into making pharma generics and IT. The last decade has been the, the formalization of the blue-collared guys to become a Zomato or an Amazon delivery boy or someone working for Indigo.
And I'm sure you have points on valuations there as well in terms of how we price. We'll get to which piece.
Valuation is what it is. I'm just saying as an economy, you need some drivers.
Yes, absolutely. And I'm going to come to that. But I want to ask you, just to complete that point, should we still expect stuff on pharma? There has been some this fear-mongering around services. I mean, actually, in a way, I said that's our rare earth. I mean,
if you switch off the GCCs from India, you're going to hurt yourself because like saying I'm going to...
So logically, it doesn't make sense. I think we should not think about that.
I won't worry about that.
And pharma, which is the other sectoral...
Pharma generics, I mean, they are so cheap that whatever they put, they'll have to bear it. So it doesn't make sense, which is why it was exempted. His problem is with US pharma and healthcare costs, which have gone completely crazy, and the profiteering. And it's very odd. If you look at the top pharma stocks there, just put Eli Lilly on a side. But Bristol Myers, Pfizer, Merck are all sub-10 PE multiples, which are innovator companies.
Yeah.
If you take even the Europeans, Novo Nordisk, Roche, are at 13, 14 multiples. So I can't understand how Indian generics facing this patent cliff, after which what else do you copy if there are no patents to be broken? How can we keep trading at the multiples we are trading at? Same thing with Indian IT, that we have these next few years where we have to create these data sets to make them AI enabled. But beyond that, the business models have to change from the pyramid structure of IT service companies to becoming a lot more AI enablers and using AI agents and so on.
So, this is, as you put it, this is a world market which is starved for growth. Growth is in what you call AI in that sense, very clearly. So, Mag 7 versus the other 493 companies.
Mag 6 actually now.
Because
Tesla and NVIDIA have Tesla and Netflix have not kept pace. The others are all 100 billion plus profits.
So let me ask you this, and it's just something that I've asked others as well. Do you think a lack of a pure play AI kind of story here in India has hurt? Because this is the dominant, if this is the apex technology of our times and people want in, then in that sense we have IT services, etc. to offer, but nothing in that.
Yeah, that's like a slow decline. It's like, you were in broadcasting and now the world's gone to OTT. It's a slow decline. It'll still be there.
We have OTT as well. I mean,
No, I'm not referring to you specifically, but
I know.
How a sector, like how these ICE engines slowly have decayed in the world as the world has gone to EV. Is the same thing happening, that what worked for us in the last 20, 30 years is not going to work in the next 10 or 15. And we have to create new growth engines. And I've been saying it for last 10 years, as long as we've been speaking, that we need to have a lot more control of IP, technology, brands. And so far, for example, you see the auto guys, they are the ones who are playing the game to at least play on technology, that they can get into defense. Or like I saw this Motherson presentation where they've gone into, for example, into airline. They supply to Airbus and Boeing. They can also get into medtech. They can get into electronics because they have the core engineering skills to scale. And I've seen every country as it grows. When US grew, they became the technology leaders. Then when Japan came in the 80s, they became the technology leaders and they were bringing product to the world. Then it was the rise of Korea. Then it was the rise of China. India doesn't yet seem to have something which can go and be dominant on world stage. And we kept harping on we are the service champions. And we sort of missed a trick over there.
But I have to say this, and you would know better since you meet so many companies. And for example, you brought up aerospace. I recently spoke with the former heads of, long-serving heads of Boeing and Airbus, and now they are sort of trying to build up this aerospace ecosystem
But
in the country.
more as MROs, right, for maintenance stuff.
Maintenance, but there's aerospace
and engineering
manufacturing
design
also.
Yeah, but who controls the IP then?
Yeah.
So the issue is like, say the Indian IT guys did all the work for the big six.
Yeah.
But the IP sat in the West. So each of the companies over there makes $100 billion PAT. Our largest company here will be, TCS will not even make a $10 billion PAT. I mean, that's the scale difference of someone who's doing work as a, how do I say, a contractor for someone as opposed to someone who actually controls the IP.
Semiconductor is a space, right? I mean, we're building packaging. There's one fab. But the point is, there is, again, I mean, we had that semicon event. There's the second phase of the subsidies which are going to be rolled. I mean, the efforts at least are being made over the last...
I mean, look, you have to start somewhere.
Yeah.
It's like back in the 80s, if you only had Ambassador and Padmini, if you did not come with Maruti and therefore that ecosystem got built, eventually you get to an automobile industry of some size. And I did say the coming of Apple in India was that moment for our EMS sector and the semi sector, that you'll get years of 40-50% growth. Now, it's like it happened with IT that you priced it to 100p multiples and then suffered for many years after that. So some of that is happening even now. And a lot of the action is happening in the unlisted space where Tata's may be actually emerging as the leaders over there. Foxconn and others have come and put their own factories over here and so on. But like I said, the value capture sits at the design stage. I mean, the money NVIDIA makes is more than all these fellows who will make whatever they want for the rest of their life combined. But it's a game you have to play. I mean, 10 years later, hopefully we get there. But
you have to start somewhere,
today.
As you said, right? So let's just close up this point. World starved for growth. What is your broad thesis? Money will keep chasing AI and hard assets? Is that the broad way to think about this?
So the hard asset bit is about currency debasement. That if they keep printing money, and even now I'm amazed that the US talks of interest rate cuts at a time where their inflation target is 2x of their own target. The market's at all-time high. Home prices are at all-time high. Gold is at all-time high. Bitcoin is at all-time high. And the Fed talks of cutting rates. If you did that in India, for example, the rupee would have collapsed. The world has taken note of this, and therefore all central banks of the world have been shifting reserves away. So gold has now crossed dollar in terms of percentage holdings of forex reserves of the major economies of the world. So gold's in a bull market really as an antidote to the dollar. It's incidentally beating our returns for our Nifty over, I think, 20-year periods. And my colleague Sridhar, he keeps talking about this for a long time. That what has India done is that suffered from an inflation and a devaluation problem for years. And by keeping our currency so debased, we've effectively killed our domestic market as well. So let's say you got a 5% GST cut, but the rupee's fallen 5%. The price of your iPhone or of your car has not really changed then. So you don't then get that consumption fillip. So that's really the risk we run. But having said that, the move to hard assets is something which alternates every 10 years. You go from financial assets and technology to hard assets every 10 years. It's a recurring cycle. If you go back to the 70s when we broke Bretton Woods, in the 70s you got this bull market which went for gold, oil and silver, famously topped in 1980. That was hard assets. In the 80s, culminating in the bull market of Japan and Taiwan, which went up 12x in that decade, was the EM era. 90s, you come back to financial assets and technology, was the NASDAQ. 2000 to 2010, we got back to hard assets. So the rise of China and in India was Vedanta, Reliance and the others, which were in a crazy bull market in that period. 2010 to 20 was again going to be back to tech. And that got extended with COVID as they printed money. And then this AI boom, it came out. The expectation was this decade money goes back to EMs, which was treated as a dead class. Like there's no money flowing to emerging market funds and so on and so forth. China was dead and flat on its back. And it started from a very cheap base. And you see the price performance of all of these in this decade is actually doing very well. I saw a CLSA report he puts out very well. He compared returns of some very fuddy-duddy companies like Tractor Supplies to Apple, or I forget the name of that company. I think Domino's Pizza versus Google, and the returns are same or probably better for the fuddy-duddy companies. So accepting something really crazy like Nvidia, which I haven't seen in my life, that you go 60x in profits. Or like this premise of Oracle, which itself seems to be based on the premise of OpenAI will spend the kind of money on you and raise the funding to be able to supply to you. And there are funny things happening there. But if you leave those 5-10 companies out, the 490 companies of the US have not particularly done very well. And therefore the money is rotated even into like Europe to go and find infrastructure stocks, defense stocks, and so on and so forth.
But your thesis then remains what it was back in April, which is top tier.
Like on a decadal viewpoint, money has to go out from, you can't be 65-70% of world market cap. That money has to move out. And when it moves out, you go back to hard assets because you've caused an inflation problem. And that inflation shows up as asset prices actually moving up elsewhere. And those asset prices are, factories are going to be costlier to build just because of these prices.
Right. So it goes out into Europe, it goes out a little bit into maybe hard assets, of course, and EMs if there is growth there, which has been a bit of a problem. Manish, stay with us. I have to take a quick commercial break here. We're going to come back and focus on India very much for our viewers in terms of where you see opportunities. So let's do that. Take that break, right back.